and good evening everyone. Today's webinar topic is the role of big data and analytics in investing. So for this we have with us Dr. Kirti Arekar ma'am, a professor at the NISM. Ma'am brings over 24 years of expertise in teaching, research, training and consulting in data analytics and statistical decision making. She has conducted training programs for renewed organizations including BSc, NSC, BCCI, INS, Mahindra and Mahindra, etc. Also, she holds a PhD in statistics, a business analytics certification from IIM Indore, and has been recognized with several honors, including Notable Women Personalities of India 2024 by Business Talks, Best Research Award by KJ Somaiya Institute of Management, Excellence in Technique Award by Bombay Management Associate. Now, a short glimpse about NISM. NISM is a public trust established in 2006 by the SEBI, the regulator of the securities markets in India. The institute carries out a wide range of capacity building activities at various levels aims at enhancing the quality standards in security markets. Before beginning this session, I would like to request all the participants to note some important points. First, question will be taken at the end during the Q&A segment. Second, all participants will receive a certificate within 3 to 4 days. Third, the recording of this session will be available on the NISM's YouTube channel. Now I request ma'am to begin with the session.
Yeah, thank you. A very good afternoon to all of you. So today's title for my webinar is the role of big data and analytics in investment. Nowadays, we observe that a lot of data is available in the financial markets. Either you will be dealing with a different asset allocation like stock, bond market, or FDs, anything. So the role of big data and how the analytics will help you to make an investment in the different asset allocation. So we will be starting the session here. So here the content for this webinar is basically what is the introduction of big data in investing. Then we can just put some thoughts on analytical techniques in investments. And then I will just give you the brief about what are the tools and technologies available. And then we have case studies in big data investment where we worked already for financial markets and we developed some models to show you how to make an investment and what are the future trends in big data with respect to the investment part. Now, first, let me start with big data. Why big data came into the picture? Because earlier also we used to we are doing the investments of the data and all that. But the challenge at the earlier time is the data is not so big. We take a small data set, taking the small historical data, and we are trying to just analyze that data and we are taking the call whether to make an investment, how much the investment we should make, and all these things. But nowadays, when we are dealing with a big data, it give you the opportunity to work together on the different phases like the collection of the data, cleaning of the data, processing of the data, and analyzing the massive volume of the financial market and the security data. So in the traditional data system often struggle to manage this data set with respect to their size, speed, variety, and the different data sets. So here in the big data technology when it came up, so it basically based on it is taking care of the volume, velocity, and variety of the data, where we can take a large data set and there are a lot of tools available by which we can process the data, we can clean the data, and we can conclude and try to interpret the data with respect to the market practitioners. So whenever the data we are taking from any server, it's very necessary that we have such type of databases by which we can extract the data. We have such type of machines where we can analyze the data, we can clean the data. So in this case, there are the several source of big data in finance. Basically, in a finance, the we are dealing with a different source of data, like market exchange data, because in market exchange data we deal with stock market data, commodities market data, and the forex market data. So basically, this data is so small that we cannot deal with a normal analytical tools. The data will directly, we need to take it from the server and to make it in a very structured manner to just analyze that data. Then there are a lot of transaction records are available for the traders, purchasers, and the transfers are made in the market in the few seconds. So we need to take care of that thing as well. The third most important thing came into the picture nowadays is the social media platform, where after the market close there are a lot of views are there, lot of blogs will be available. When you go through the Twitter, LinkedIn, lot of views where they can just give their views and the ideas that which stock to be buy and which stock to sell. So, to analyze this qualitative data, we required the machines which is having the capacity to take the data directly from the server, and by that data we can do some text analytics to analyze that what investor thinks in the market or what are their views on the particular stock, because it is affecting the prices of the stocks time to time, and then we need to be very careful that whether all that views and the blogs are correct or whether we should rely on that. That's why we need all these big data sources and the big data machines where we can just analyze that data. And the most important is the customer interaction, because when we are taking the feedback of any particular product, if mutual funds or anything is there, we need to take a feedback from the customer that what mutual fund they want to prefer, what they don't want to. So based on this feedback, our investment pattern will get impacted. And the behavior analysis, that what is their behavior at particular time when the market open or when the market close. So for all this view and to analyze this data, we need the sources by which we can take the data in a particular format, in a structure format, and we can interpret the data. Now, here the source is also the important. Now, we can just discuss about the importance of big data in investment strategy, because as we get the data, as we build the model, so what are the strategies we need to find out? Now, lot of tools available, lot of technology available by which we can analyze the data. So the first, I always feel that big data always analyze the massive data sets quickly and very accurately, where we analyze the historical prices and then we can just see whether the prices are normally distributed. If it is not, if the major outliers and the minor outliers are present, we need to remove that by using some tools, and then we can just develop the model, and then we can take a decision and take a informed decision based on that real time data, because that is the most important thing, and based on that we can decide our portfolio. So for example, if I can say, the investment firm can use the big data, that how to monitor macroeconomic indicators, then the industry trends and the geopolitical events, how this impact to our stock market, bond market, or mutual fund data, so to take the informed investment outcome and relate it with our decision pattern. Second is the identifying the market trends. Yes, the big data will easily give you the, we can develop the predictive model by using real time data, and where we can make our strategies, when to enter in the market, when to exit in the market, or at what price we should buy and at what price we should exit from the market. So in that case also, to identify the patterns of the market, we need big data, as well as lot of statistical tools are available. So by this statistical or the analytical tools, we can improve the decision of investing in the market. So that is the two decision I feel there are, but lot of applications are there. Now we are going to discuss about the analytical techniques which we are using maximum time in the investment. The first is the predictive analytics. This is the it is related to the forecasting technique. The most important with respect to the investing part, like forecasting the stock prices. So where we take the historical data first, then we clean the data, and then we, as discussed, we try to bring that data normally distributed by removing the major outliers and minor outliers by using some techniques. And then we develop our predictive model to just see that what will be the forecast stock market price and what will be the future prices. Now, here in this case, a firm may also use the machine learning models where they take a past data and to manipulate the stock behavior sometimes, and which can improve the buy and the sale prices of the stock market. So there are a lot of techniques available, but initially we need to clean the data, make the data normally distributed, then prepare the model in that way that when any particular stock will market will go up and down, so what will be their predicted scores or what will be their predicted prices. In that case, we use this forecasting stock prices. The second most important, I always feel with respect to the investment, yes, the risk assessment is the most important, because as we are investing, we are majorly depend on the what will be the potential loss in the market. Suppose the market will go down or up, so what are the maximum losses we need to bear, or what are the maximum profit we will gain? In that case, also we use the analytical tools, and there are various factors which impact this risk assessment, like market volatility, economic indicators also, because based on that we can see the impact of economical indicators as well as the market volatility on the market. And then we develop the portfolio in that way where we can minimize our risk factor. So while I just say that when we are evaluating the exposure of potential losses, so we will be using the market volatility, even the interest rate also, credit ratings also. It is also impacted the stock market sometimes. So not only the stock market, I can say it impacts all the asset classes. So we need to build a model in this way where we see the impact of all these variables on our asset class, like stock market, fund market, or mutual fund, or any bond market. So risk assessment will give you the time where like how much money we should invest and when to invest, what are the percentage, and what are the percentage we should do. It also suggests you the portfolio rebalancing if the data indicates the rising volatility in a specific sector. So they help you to how to rebalance your portfolio. If you are selling any particular stock, so in that case, if I sell the particular stock, so at which stock we can take, so we can minimize our risk factor. So that is the first, I can say. The second most important, this I think in the last 3 4 years, this sentiment analysis came into the market, because if as my personal opinion, I observe that whatever the social media platform is posting the blogs or the views on the particular stock, it is getting more impact. Because based on that impact, we just see what is the public sentiment about the particular stock, what are the trading strategies which can we can find out from real time public opinion. So in this social media monitoring, we always use the text analytics to identify that which particular word is repeating in the blogs, which particular feedback is given by the investors or the other parties on the social media side. So we do this sentiment analysis where I can say a lot of tools are available, like brand watch and whole suit analysis. Twitter is there, whether in that they write the opinion about the particular stock, and from that particular sentiments we can analyze and we can see, okay, so the buy of that particular stock is maximum, the words is repeating in that particular block maximum time, so maybe the sentiment will be positive tomorrow. So in that case we use this. The second, in the sentiment analysis, it's not only depend on the blogs or the feedback we are giving, but it is also depend on the news sentiment index, because it also assess and combine all the news articles related to stock, and how much it will reflect on your index and the investor sentiment, or it what will be the movement, market movement, and the stock performance. So basically, the news sentiment index compiles compile and source news article, and it will predict the tone of the investor behavior and the market direction. So they can just if the positive or the negative feedback, based on that they will see that if the tone is positive, so there are the chances the market will increase or maybe decrease. So this is also the important part. Earlier, we are not doing this sentiment analysis so much but nowadays in last 3 years it increased so much that we need to find out while making any investment. We need to do the invest whenever we are finding any investment patterns. We need to do this sentiment analysis. So basically, this is a qualitative analysis where a lot of techniques are available. Text analytic is there, which will the best technique to identify that what is the sentiments in the market. So that is one of the technique. Uh, Now, regarding the tools and the technology we are using with respect to the investment part that we are going to discuss. So the first most important, when we are having the data, the first we need to take care about the data management platform. So what platform we are using to save the data, what are the resources or the scalable resources over the internet we are using, so which allow the organization to store and manage and the process the data with a massive infrastructure. Earlier we are taking the data on the server. Now our data will get collected on the cloud, and from the cloud we can interact with that data and we can develop our own model. So basically the data management platform will be the in a simple language, if we can say, collect and organizing the large data set or big data set for analyzing and the storage. So the solution for that is the first solution we already discussed, like the cloud computing solution, where we don't require the space. Without investing in the space infrastructure, we can take this solution and we can save the data. So in this cloud computing services, we have some example like Amazon Web Services are there, AWS, then Google Cloud is there, then Microsoft Azure is there, by which we can take this cloud services and we can save our data. The next is the most important is the data warehouse solution. It centralized your data basically, because as the data is in different sources, different machines and different this. So basically the data warehouse source solution will save the data, and it will give you the full data set, full data in a one platform. So here we can save the unstructured data, structured data from our different sources. And if we want to analyze that data, we can directly take that data and we can just take a decision. So basically in this, I can just give you some example like Snowflake is there, then the Amazon Redshift is there, which support the real-time analytical data for reporting and for analyzing. So whenever we are dealing with the data, so basically the data management platform should be very strong while doing any while taking the decision in the while taking the decision with respect to investment. And the second most important, I will say that the analytical softwares is the important thing, because we need some tools and the technology or the techniques which we can apply on the data to take a decision. So first, statistical analytical tool are the data which generate or which analyze the complex data by using different statistical methods and to take the decision. So nowadays, the statistical analytical tools, there are the open source tools are available like R, Python, even SAS is there, Tableau is there to creating the dashboard, Power BI is there to creating the dashboard in few seconds. because if you are working in Excel, it takes time, but while using Tableau, SAS, as well as Power BI, Python, it will give you the dashboard on the daily basis in a few seconds. So, and the most advantage of that tools are like, suppose if you connect that software with your databases like BSC, NSC, or any other sources. So as the data will get changed in that, so automatically your dashboard will get changed, and there is no need to do the graphical representation again and again. So automatically, if the data will change on the databases, your dashboard will get changed, and you can decide that which stock is on positive side or negative side, or with respect to the interest rate of the predict the interest rate with respect to the FDs and the bonds and all that NAVs of the mutual fund. So that are the tools available. Then the I can just say the advanced machine learning applications are there, where once we do this, all the dashboard, creating the models, then we move to the algorithms, because here the machine will not read the data or perform any task. We need to build our own algorithms by using the softwares, and that algorithms we can put it on the machines and give some benchmarking. Okay, the price will go till 20, we need to sell, or we need to like buy the stock. So it basically identify the patterns and predict the outcomes based on the historical data. So it is an automated process where our predictive model will uh, behave in that way. Like we need to only put the value, we need to see if the stock will reach at 300, so what will be the strategy. So all these algorithms prepared by the human beings by using the tools like R, Python, and all that. And then we just put it into this algorithm we can directly use by using any machines, and they can run. So there are a lot of machine learning algorithms are available, like we can say random forest is there, neural network, which can detect the patterns and which automate your predictive modeling. So this is also a very important task. Now, with respect to the case study in the investing in data analytics, the successful implementation, I can say the hedge fund utilization in big data. So here, hedge fund big data enhance predictive, which optimize your trading strategy. Like there are a lot of different decision taken by the investor. Some will say buy the stock at this rate, buy the sell the stock at this rate, but we need to identify, or we need to optimize the funds, we need to optimize our strategy. So hedging fund will use the algorithm trading, and which will take care of risk modeling also, and which will identify the arbitrage opportunities where we can manage risk as well as, and we can improve the investment performance at a higher return. Because when we are making an investment, the objective is always like maximize the returns and minimize the risk. So taking both the objectives together, we need to see that how much investment we should make. So hedging fund, like suppose if I have 50,000 rupees to make an investment in a particular four stocks, so I need to identify that how much money I should invest in the first portfolio or the second company, third company. So overall, I can optimize my portfolio by maximizing return and minimizing the risk. So both will be created by the optimization method, and which can perform the investment, which can taking our investment performance in a very good way. The second implementation, I can say the retail investment strategies, because uh, investment strategies are increasingly employing the big data platform to analyze the market trend. Even they also just check what will be the financial instrument, what will be the strategies. So here the tools like Robinhood is there, Zero, the Upstock provide the individual investor to access the big data, because on the back end they do the analysis, and they will give you the solution that they will give you the not a solution, we can say they will give you an idea that what should be the investment, what will be the options, what will be the other strategies we should decide. Even they offer the personalized dashboard to create, like stock screeners are there. Even they will give you the chance to build the alerts based on the stock market movements and the user behavior, so you can put the alert on the stocks when to buy. So like putting all these alerts and putting the creating the dashboards and creating the stock screeners on the back end, they use the like a tools and technology of investing, like a many statistical and models, different machine learning algorithms they use, and they will directly give you the solution that what will be your strategies, what how to make, they create the dashboard on the back end, and they will give you in the ready-made format that you take a decision. So these are the retail investment strategy, they use all these things. Now, we are going to discuss about the future trend in data and investing. So basically now, there are a lot of upcoming technologies are coming up. So lot of new models, or the new field is coming up in the field of investing, in field of data analytics, in field of the big data. So the first, I can just say, the rise of artificial intelligence. Now the AI powered trading algorithms are built, where the algorithm use the machine learning models to identify the market trends and taking the decision. Even algorithm process the large volume of the data, real time data, and you can take a decision. For example, if a high frequency data firms use AI to execute the trades and within the milliseconds, so that such type of big AI algorithms are already built, where we can deal with a high frequency data to execute the trade at what time, at what level. So that is also coming up nowadays, and there are a lot of tools has been created on the base of a lot of tools are there in the market, where you can see the what will be the suggestions or the decision you can take. The next, I can say, the robo advisors and the personalization is there, because the robo advisor will give you the personalized decision and advice that what should be your investment pattern, what if interest rate will be increase or decrease, when to break your FDs, or when to invest more money or in the different asset allocation task. As well as they can just optimize your portfolio based on the individual risk preferences and the financial goals. So we need to give our objective that what at how much money you have, and at what time you want to invest, how much time you want to keep that money, when you want the money back. So investment advisors, they can just optimize their portfolio based on the individual risk and their financial goal based on that. So there are a lot of robo advisor platforms are there, Betterment is there, Wealthfront is there, which automatically using this AI to personalize your portfolio on the individual goals, and the risk profile. So basically, if you are going for AI and the robo advisors, so first I always prefer you need to do your analysis of the data by your own, because understanding the data is most important when you are taking the data. So for how much year you will take the data, first clean the data, process the data, and then make the dashboard from that, and then after that you can try to analyze that data, and then maybe to confirm your results and outcomes, you can take a help of this AI algorithms and the robo advisor. It is there in the market, but uh, only rely on that is not only the part. We need to be very vigilant while taking all this decision, because money is involved all in this part. So we need to take a decision on the both the things. First you analyze the data, you build the dashboard, you do some model building, and then you can go for this further steps. The regulator consideration is a ethical consideration is required, because see, data analyzing investment and all this is okay, but we need to take the consideration all this issues what we are having. So data privacy issue is the most important thing, where we need to, because when we are going for big data, so it involved the protection of a personal information cannot be misused, and we require the compliances with respect to the laws, and we need to ensure the customer trust. So we need to say if any particular customer is sharing the data with you, so you need to give them the confidence at what level you will you will not misuse the data, and you will not like sharing the sensitive, safeguard the sensitive data. So that is also the most important part while doing the investment. So now the data privacy issue, earlier it was very difficult to just check and to just find out where is the issue, but nowadays we have so many systems are available, so many tools are available by which we can check whether there is any data leak is there or any misuse of the data is happening. So we can find out by using different websites are available on that. The second is the compliances with financial regulators. Yes, there are a lot of laws and a lot of regulator bodies like SEBI, SEC, FCA regulate the rules, and they can involve they suggest you to just adhere by their laws while taking the financial activities. They ensuring the transparency and protecting the investor, and I feel this is the most important thing while doing the investment nowadays, because investment firm must implement the compliances framework to avoid the legal penalties and maintain the investor trust. So that is also the most important thing we need to check before we are dealing in the market. Now, I'm putting some of the examples of the analytical tools in investment markets. So here, first the analytical tools. Basically, analytical tools is the combination of three things. I always say there are the three phases of the analytical tools, whether you are investing or whether you are in the market. The first is the some portion of maths will be there, some portion of statistical tools, not some portion, but statistical tools are there, and the third is the computing power. So that is also required. So when we are talking about the analytical tools and the mathematical technique which is used to collect, analyze, and interpret the present data, and which help the investor to take a data driven decision based on the empirical evidences. So I always suggest the investor, or I suggest whenever you are in the market, first you analyze the data, and then you can just see the do the comparative study, and then you can recommend, or you can take a help of other AI tools and all that. The second, I can say the decision making, like when you analyzing the data is not so difficult. There are the tools available. You can directly put the data, you will get the result. But the most important is that what is your objective? Like suppose if you want to make an investment in a particular stock A, so what is your objective? In which sector you want to go? How much money you want to invest? And how much risk you are able to manage, or how much risk you are able to take, that you need to be very clear when you are doing this data analysis. So here I can just say the investment decision making, we can forecast the future trend, evaluate the risk, and optimize your portfolio before you go for any particular uh, investment part or using any analytical tools. So basically, there are two methods available on analytical. One is the descriptive analytics, which is called as descriptive statistics and inferential. So descriptive statistics is basically used to create a dashboard, because we have the data in a raw format. So in the raw format, it is very difficult to read the data, because when we are in the market, financial market, the data will be available in thousand lakhs. So it is very difficult to analyze that data. So I always prefer, we need to make our data in a particular tables format, or do some graphical representation and organize that data first to understand that what is there in the market of the last. Suppose if you are taking the stock of last 10 years for particular stock A or any particular company, Then first you need to organize that data, first clean the data, organize that data, normalize that data, just see whether outliers are present, remove that outliers, whether it is higher side or lower side. And then you can just do some descriptive statistic, like what is the average performance of that stock, then what will be the 50% investments are at what part, like suppose 50% investment is less than or greater than, and standard deviation, that is basically the risk factor, how much standard risk is associated with each stock. You need to do these things in the descriptive statistics, and then you can connect this with the different assumptions. Suppose if, for example, I will give you, if any particular stock the average return is 20 or maybe 200, so the next question came into the investor mind, so what will be the scenario, whether the price of that particular stock will increase, decrease, or it will remain same. So you need to go to the inferential statistics to prove your assumptions. So basically, these assumptions you need to prove by different tools are available, like hypothesis testing, assessing the investment risk, confidence interval, and to prove this assumption whether the stock will increase, decrease, or maybe it will be the stable. So such type of decision you can take by inferential analytics. So basically, when you are doing any type of analysis, the two things is most important. One is the descriptive and the inferential. So in the descriptive analytics, we will organize the data in a raw format, in a table and graphical representation, creating dashboard, and then we can decide some of the assumptions, and based on that we can see that which assumption is true. So suppose if you are saying if my average stock returns will increase by 200, so then by inferential analytics you will get whether it is increase or it will decrease or whatever, which assumption is true out of this. So that are the overview. Now there are common analytical tools which we use, which are basically used like a regression, simple regression, because simple regression is most important, because when you are investing in the market, it does not have only the one variable. We are having the different variable, like if you are investing in the market, it will get impacted by the different scenarios, like different news, or we can say the views of the investors, or maybe we can say it get impacted by the commodity or the commodity or any other markets, or the we can also see that how much impact of the like US and UK market on our market to predict the outcome. So that is the important thing. Multiple regression, they both are using the simple regression, we basically use to predict the outcomes based on one and two variables. Multiple regression, we use several factors like the economical indicators, technical indicators, fundamental indicators, and we can just see how much impact of there on our particular stock, which help the investor to understand that what how much influence of that all variable. Then we have forecasting technique, which is basically depends on the time series analysis, like moving averages are there, exponential smoothing. So moving averages will give you at what specific period which investor identify the trend of reversal in market movement, that you can identify. Exponential smoothing gives you that how much weight you should give in each asset class. That suppose if you want to invest 1 lakh rupees in the markets, it's not necessary that you can go for stock. There are other asset allocation options are available. So you need to decide that how much percentage we can go on stock or FDs or maybe bond market or the mutual fund. So it will give you the model that this is the percentage we can invest in each asset allocation, which will optimize your portfolio with expected maximum expected return and minimum risk. Then we have the risk assessment tool where we use maximum times value at risk. So value at risk quantify the maximum potential loss on investment portfolio. So it will give you that if the market will go up, so we can calculate the downside risk associated with the investment. So it will give you, suppose if you calculated downside risk, so it will give you the solution, like tomorrow market will go down, so how much potential loss you need to bear in the market. how much is the expected loss. You suppose 6% is the downside risk. So whether the tomorrow market will go down, so 6% is the losses we need to bear, and how much upside risk also you can calculate. Now, the next we can say the standard deviation. Basically, standard deviation is associated with a risk factor which will give you the variability in the investment pattern. And suppose if you have different asset class, so how much price fluctuations are there? Now, standard deviation is lower, so we can say risk is minimum. So in that way, we can identify if you have four stocks, calculate the standard deviation, and the minimum standard deviation means the low risk, then you can go for that. So that are the tools basically we use in the with respect to the investment pattern. Now, the most important example is the portfolio optimization, where we called it as a MPT framework, where uh, the we just apply this technique to minimize risk for the given return, and which majorly emphasizing on the diversification of the portfolio. So this theory is also used by different tools and technology, and the Sharpe ratio calculation, which can compare and give the performance of the investment with a risk-free asset by adjusting the risk and all that. So it helps investor to understand the return per unit of risk taken, that by which how much will be the risk and how much the returns will be there. Again, this is the most important part which I always considered with respect to the financial market is the benchmarking techniques, because the benchmarking techniques involves comparing the investment performance against the standard index or the benchmark. Like suppose the market will go up, so how much it will get impact on a particular equity of particular stock, that we can see by benchmarking technique, which help the investor to assess the relative performance and take a decision. Because benchmarking techniques, because there is no benchmark currently, but yes, we can just relate it with our the standard index, or we can normal index, we can see that how much impact is there. The next most important concept which I always feel it is there, like alpha and beta analysis, where alpha indicate that how much investment outperform or underperform a benchmark. So when you are calculating alpha, it will just tell you that what are the investment which is outperforming and underperforming with respect to the benchmark, while beta measures the volatility in relation to the market, because it give you the informing the risk assessment and the investment strategy. So beta is basically give you the idea about the volatility. Alpha will indicate the investment whether the investments are outperforms or underperform with respect to the different benchmark. So in the performance management, these are the two techniques which I always feel very important while you are in the financial market. Now, whenever we are dealing with the tools and the technology, there are a lot of limitations are there, because a lot of limitations, lot of constraints are there. So we need to take care of that while doing this. So the first is the data quality issue. Yes, I said like first when you are taking an inaccurate data, because when you are having the inaccurate data, which always misguide your investment decision or the faulty assumptions, because basically we take a historical data, so we need to find out whether our data is accurate, what period we should take, from which period to what period we should take a historical data to build the model. And because if you take randomly any data of last 3 years or 2 years, and if you build the model, maybe the your forecast model or the predictive model will fail to give you the answer. So always reducing the reliability of forecasts and just potentially resulting in financial loss. You always check the data quality, because what whether your data is accurate or inaccurate, you need to take a call. Second thing, I always say noise in financial data. Yes, financial data always often includes the random fluctuations or noise that will impact the trend. And I can say making it difficult to develop the models. Any model, whether it is machine learning, deep learning, or maybe the statistical model, because it will the for statistical model, it will not distinguish between the relevant signal and the irrelevant randomness. So that we need to check before you are going for any statistical tool. The third, once you build the model, when you created the dashboard, the second is overfitting in model. Sometimes when you are prepared the model, so there are underlying patterns are there, which always lead to poor predictive performance, and which misguide the investor to their strategies. Because overfitting in model, sometimes our model accuracy comes above 95 or 98%, because I always feel above 95 is a very, very rare case. So that may be the problem of overfitting the models. So that you need to check before you go for any investment things. Then the assumption of statistical model, because whatever the assumptions you are taking, you need to decide that what relation you want to build, what prediction you want to build while doing the model risk. Now, future trend basically in machine learning and AI integration, the predictive analytics and the automated trading systems has been created. So in the predictive analytics, the historical data and machine learning algorithm is there to forecast the future trade as an investor to make an informed decision with lower risk. An automated trading system utilize the algorithm directly to execute your trade in a predefined manner. So it is more efficient trading and better take the advantage of the market opportunities. Uh, Now, big data utilization, I can say real time analysis, because real time data we are taking and we are streaming with respect to big data, the large volume of the data, we are getting opportunity by different uh, sources to take a use of that data. And then we enhance our forecasting technique, because a lot of technique are there by which we can forecast this. So in this case, there are a lot of things we discuss about the investing, what are the tools. So it is just introductory that what are the tools and technologies are available. So in next 10 minutes, we can take a question answer from your side. So if you can just post it in the chat box, I think there are a lot of questions are there. Uh, yes, I think Kiran asked that social and sentiment analysis, does it have some value or index, or all subjective? See, Kiran, one thing, when you are doing the sentiment analysis, only the sentiment analysis, believe on sentiment analysis and taking the decision will not solve the purpose. I always believe when you are doing, do the qualitative and quantitative analysis together, because without only doing any single thing will not help. Always whenever you get the data, try to do qualitative and the like quantitative, both the thing. So like again I will have I think uh, how NISM help in scaling? Yes, NISM is already having their data science courses. If you go on the site, there are 3 courses on data analysis, like a data science basic course, advanced course, and fintech course. So you can take that as well. What is a parameter of mutual fund? So when you are dealing with a mutual fund, so you need to take a performance or the balance sheet of that particular company, and then you need to see that how much dividend they are getting, what type of category of mutual fund, how much risk is associated with that. Then based on that, you can decide that which mutual fund to buy and when to sell that. So do you have detailed course on this? It is on our website, please check on that. We have lot of courses on data science courses. Basically it is based on the data analysis, so that is also there. Mm. One is respected as a banker, how the big data analysis help in building huge portfolio optimization bearing AI and robot machine analysis. Basically, Prashant, I can say that as a banker also, if you are dealing with a data of huge portfolio, so lot of tools are available nowadays. Like we have AI, we have like R and Python, which can directly run the models, and no need of AI in robot machine. Yes, AI is required to just see later on. But if a general, if you want to build the model, so that you can use the tool like R and Python and develop the models. So that is also possible with respect to the data, huge data, whether it is from the banking or any other sector. Which one is the best statistical software for analysis? Uh, Actually, I cannot recommend any one software, but my recommendation is like R and Python is there to analyze the data, but I prefer just learn any one. Don't try to like learn both the softwares together, because if any softwares you want to learn, be master in that. Because if you learn both the softwares together, it's very difficult to be master in one. So either you go for Python if you feel you Python. So I always prefer to, I always give the suggestion, if you are from the IT background, then you can go for Python, and if you are from analytical background, then you go for R. Because it is my personal opinion that those who have the R analytical background, they are more comfortable with R. But please don't try to learn all the softwares together. Learn any one software in a deep, learn the concept in depth. You can learn that and hold your confidence on that. So that is the most important thing. Uh, yes, there are a lot of on the courses. Can you just send the mail to our department, academic department? Difference between the normal data science course and the open market and NISM data science course. Yes, here in NISM, whatever the data science courses we teach through the financial market data, like it is not only stock, but any financial market data. What are the ways of AI can be used in the big data? So basically, if you are saying AI tools, so generally we just discuss like Zerodha and Upstocks. So Upstocks and Zerodha is taking the help of the big data analysis, and they are creating their own AI tool. So basically, there are a lot of tools has been created. Robinhood is also there. So they created the tools with respect to big data, and they are using as a AI tools. Uh, can we connect one to one? Yes, you can drop the mail. Any other fundamental actually I feel in the market everyone feel like the this data science or the analysis is very difficult. It's not that way, but I always observe that individuals are having the different perception. They usually want to learn everything together, so that should not be there. So always try to concentrate on any one platform and just try to learn that. uh, is this also like derivatives, when after sometimes SEBI comes up and say 90% of this are losing by doing AI in big data? Yes, I already informed that if you are doing AI and big data, I cannot say that you can lose the money, but initially I always prefer, if you want to take a help of AI, so first you do your analysis of your market, of your stock, your asset. First, you do the analysis, and then you can just check your analysis with AI and then take a help of that. Because directly only on the one tool and you are making your comments on this, it's not possible. So always I prefer ki you do your own analysis, create a dashboard, develop the market, develop the models, and then you can take a help of AI if you stuck somewhere. Uh, how it helps in algo trading? Yes, algo trading is it does not mean that the machine is doing all the things. Yes, it is available in the US. Yes, Stephen. So algo trading is not that way. Like it machine is doing any work. We need to prepare our own algorithms by using machine learning neural network, and that algorithms we build in the machine, and benchmarking we need to give, and based on that our machines will work accordingly. So that is the thing. Robinhood is a US broker. Yes, it is from the US, but I just took the example that any examples like you can have. What Python library do I need to expression on so far make? In the predictive model, there are a lot of Python libraries are available. Sumit, if you can search in the Google, you will get that. And now you have the help. Many AI tools like ChatGPT, they will also help you in this. When NFO is launching by an AMC, which analysis should be followed best applicable for investor? So whenever NFO is launching by an AMC. So here you can just do the predictive modeling to check the background of that particular company and the performance, and do the predictive analysis and just check whether what NFO is launching. So what will be their predictions based on that launching. We have learned about Python. There are, what are the factors affect our investment? Name them, please. Investment, there are no like one or two factors. There are many factors affect. So first, at the initial level, if you want to go for quantitative analysis, we can say technical is there, technical indicator, fundamental indicators, and there are a lot of other indicators or lot of other like a global market scenario, working of global market, their market strategies, they will impact. And with respect to the qualitative, I can say the social media, blogs, and the news articles and all that get impacted. So as a factor, only one or two factors are not there. There are many factors are there which will impact. So always do the overall analysis, not only the sentiment analysis. Apply all quantitative and qualitative tools. Okay, so personally, I think there are a lot of models I apply usually. So I think this is there are a lot of things we do on the stock market, developing dashboard and all that. Yes, I think I hope I solved all the questions, and there is nothing. So I shared my all the valuable whatever the knowledge I have. So thank you so much for attending, and all the best, and do well in the investments. Thank you.